Everyone tells you that stocks are great because they go up long term. And yes, this is true. The S&P 500 is appreciating over the decades. That here is the linear chart. Here is the same on a logarithmic chart. But this is a very long-term chart. It starts in 1871. There are stretches where the S&P 500 is just going sideways. That's now over 14 years. Over here, that's over 13 years. And this is all measured in US dollars. And the problem is the US dollar is devaluing over time. A US dollar today is worth more than a US dollar in 13 years. Relative to the money supply, the S&P 500 can drop by 73%. This is now from the year 2000 to the year 2009. So we've got the dot-com crisis over here and we've got the global financial crisis over here. The dotted line, that's the average ratio of the S&P 500 to the money supply. The fundamental question is the following. Yes, stocks are appreciating long-term over time, but does it really make sense to always save in the S&P 500? Or maybe when valuations are very high, would it make more sense to maybe just pay off a bit more of the mortgage, or to maybe rather buy some gold to save a bit in gold instead? Maybe we should allocate something into fixed deposits even, or maybe we should buy a solar energy roof. What's really the best investment at a particular point in time when we look closer at the numbers? Hi, my name is Gerhard. I'm in the investment game for the last 8 years. I hit my first million 3 years ago, and in this video I share the data that I use to allocate my capital properly, that we actually outperform just buying and holding into the stock market. On average, over the last 6 years, I have outperformed buying and holding Bitcoin, and that was on average by 2% per month. Not every month is positive. There are some months where I underperform, but the long term matters. The link is down below in the comment. That's here in copy trading. But there's also another link here, track record. And this is where I share every single trade that I've made since publishing this in real time 2 years ago. And that's then this performance graph over here. Once you are logged into the platform, you can also verify every single trade. So the entry, the exit, it's all connected to the Telegram history. I try to be as transparent as possible. Now, just because the S&P 500 goes up over the decades does not mean that we should always buy into it. Maybe other investments at particular points in times are better allocations. And that's something many people miss. Very few people actively manage if they should now use their savings to maybe pay off the mortgage faster, or to maybe buy into gold. During this stretch here, where the S&P 500 underperformed the money supply by more than 70%, gold relative to the money supply outperformed by almost 300%. Now, nobody has a crystal ball what's a better investment at a particular point in time, but it seems like there are some cycles. Sometimes gold is doing poorly and stocks are doing well. Sometimes gold is doing well and stocks are doing poorly. This is again the S&P 500 relative to the money supply. Maybe we can use a trend following strategy. So when we are below the moving average, we rather buy something else and not stocks because they are currently not favored by the zeitgeist. And sometimes it might make sense, once we are above, to allocate more towards stocks again. But the question is, what is the best moving average? What's the best white line here as a decision maker? That's where the backtesting platform comes into play. Bitcoin strategy analytics, we are backtesting the S&P 500 relative to the US money supply. We're looking at the weekly data, and then we get this chart here. On the x-axis is the weekly period of the moving average. On the y-axis is the annualized performance. And the best result is over here, the 36-week moving average. If we time the market using moving averages for the S&P 500, we should use that data point. And interestingly enough, that's then the line. It's very, very close to the current prices. How much does this outperform buying and holding? Roughly 1.5%. And that's now assuming that the capital that we take out of the market is not deployed in anything else. But fundamentally, the question is always, what are we doing with the capital that we don't put on the S&P 500 or into stocks in general? If we, for example, sell off our mortgage and our mortgage has some financing costs of say 4% per annum, we are not just gaining the 1.5% over here by avoiding a crash, we are also gaining say the 4% that we save by not having to pay the financing for the house. Here is then how that looks like over time. So the S&P 500 is the line in gray, or here the line in white, and the portfolio line where we get out of the S&P 500, that's in blue. And then that capital can be used for something else. The main advantage of that strategy is that we don't get caught up in those crashes. 46% over here and 38% over here. Again, I'm not making the argument that we should sell all of our stocks and just be on fiat currency. I'm making the argument that we should look for other investments when times aren't that great for the stock market. Versus fiat, the stock market of course goes up over time. But that does not mean that it's always the best investment. When versus the monetary base, it goes down by 73%, while other things, such as gold, could appreciate, or other things, such as a mortgage payment, could be reduced. Now, using this moving average is not necessarily without problems, especially if you have to pay capital gains taxes, and if you are in a jurisdiction that doesn't like that you're getting in and out of the market. And so then you can just use the very long-term indicators, like the Shiller PE ratio, right? The long-term price to earnings ratio of the market. When we buy a stock, we always buy its future earnings. Price versus earnings really gives us an insight about valuation of stock markets. Now, this valuation currently is very high. What this basically tells us is that the market is anticipating very quick earnings growth for companies. If the earnings, if profits don't go up massively, then the current valuations are not justified. But if they do, then of course they could rise further. Because we could have made the same kind of argument in 1997, right? We were at similar valuations to the height at the end of the 1920s, just before the Great Depression. But still, subsequently, we went up by another 50% in valuations. I'm not saying that we are now topping out, but we are definitely not cheap either. We are now betting on the economy becoming much more profitable in the not so distant future. What I am saying though is that the S&P 500 is probably not the best vehicle for stock allocations. So if you're now diversifying your investments in various asset classes, so property and stocks and crypto and precious metals, etc., then probably the stock allocation should not just be an S&P 500 ETF. And that's shown in this chart over here. This shows the S&P 3, so the top 3 stocks at any point in time, versus the S&P 500. The S&P 3, that's the line in blue. The S&P 500, that's the line in orange. This is now on a linear chart, and here's the same on a logarithmic scale. So just at the end of the year, we look at what are currently the 3 largest stocks in the US, and we just buy them based on their market cap weightings. And while this used to be, say, Apple and ExxonMobil and Microsoft in the past, now it's Nvidia, Apple and Google. And if you just bought those top 3 stocks and you held them for a year, and then you look again for the top 3 stocks and you hold them for a year, then you're outperforming the S&P 500 by more than 7 percentage points every single year. And this is a long-term backtest. It starts in 1990. If you just held the S&P 500, you would have turned $100 into $4,000. That's not too bad, but this is a long time horizon. If you instead used the S&P 3, you would have turned the $100 into $42,000. So those 7 percentage points in difference make a 10x over those 36 years. So here's the performance of the S&P 500 versus S&P 3 annually, and here is the alpha. The S&P 3 really does much better, and the volatility increase isn't even that significant, right? 17% annualized for the S&P 500 versus 25% for the S&P 3. The risk to reward is definitely much better for the top 3 stocks. We don't need all of those 497 stocks below that. 500 is a very arbitrary number. It's definitely not the number that optimizes our risk to reward. And so yes, you could keep it simple. You could just always allocate to the S&P 500, set and forget, and not do anything about this. This does work. This does escape the monetary debasement. However, it's also very costly not to go beyond this. It's very costly to buy stocks when there's also very cheap other asset classes at the same time. It's very expensive to not optimize, to buy all of the S&P 500 stocks when historically the top 3 stocks outperformed that much. There are many ways to optimize investments, and again, over a long enough time period, it can make more than a 10x just from the switch of the S&P 500 to the S&P 3. It's a difference between potentially having to struggle in retirement versus having that much money that a lot can be given to the next generation. It does make a difference. It is knowledge worth accumulating. And if you're willing to invest that time to dive a bit deeper and to optimize your investing, then feel free to check out the premium membership. This is also where I publish a lot of tutorial videos showing my thinking about asset allocation, about market timing, about how we can actually make more returns compared to just believing the story that's too simple. That's definitely suboptimal. That's just buying the index and doing nothing beyond that. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.